Should you take your Social Security early, given the market craziness? And the market's come back around since the March 20th, I think, was the decline. Still, a lot of people are going to be intrigued by just locking in what they got to make sure they get it now before Social Security is taken away, before it goes bankrupt, before this, before that. I get it. We've heard these things for years and years and years. It's not going to happen. Even the trustees report says, wow, in 2034, we can only pay roughly 75 cents on the dollar. And the reason for that is because the payroll taxes will still pay 75% cents on the dollar. No one's saying you're not going to get anything from Social Security. So let's just rest that argument and be done with that, because that's just silly. If you just look historically, no politician has ever survived pulling people's money away. So what they're going to do is they're going to raise the payroll tax, probably increase their full retirement age, probably reduce the delayed earnings credits and all that. But for those of you right now who are looking at Social Security, man, it is more valuable now than it was even a year ago. So don't pull the trigger, man. I'm just telling you. Unfortunately, a lot of people do pull the trigger when markets go chaotic and recessions happen. And that's too bad, because Social Security right now, the 10-year Treasury is paying 1.35. You can lock, the 30-year Treasury, 1.35. The 10-year Treasury is paying 0.65. So that means you lock up your money in a government bond for 10 or 30 years, you're getting between 0.65 and twice that, 1.35 a year. $100,000 in a government bond would pay you $1,300 at 30 years. Every year you're making $1,300. $100,000 in a 10-year Treasury would pay you $650 a year. That's it. That's Social Security with the 8% delayed earnings credits plus what we hope to be some sort of cost of living adjustment. 2.4 is what the trustees report are saying between now until 2095. Still, at the end of the day, we don't know. It probably won't be that this year, but either way, an 8% delayed earnings credit relative to, we'll just say, a 1% bond yield, that's a significant, you're giving up a huge upside with delaying Social Security. Whereas when you get 5% on bonds, that's a whole lot less that you're giving up if you're getting 5% on bonds when you're only getting 8% delayed earnings credits. Right now, delaying Social Security is the most valuable thing you could possibly do ever, because we've never had bond rates this low for this long. It just hasn't happened. Unfortunately, many people aren't going to do that. So let's read a couple articles here, because during recessions, most people tap into it. Here's Amanda Chase from Horse's Mouth, Savvy Social Security Planning, but the actual article is Squared Away blog from the folks at Boston College Center for Retirement Research. And what they say is happened in 2001, and 2008, and 2009, and it'll happen again. Some older workers who lose their jobs will in turn take Social Security early. They'll take it at 62. In 2009, 1 year after the stock market plummeted, 42% of 62-year-olds signed up for the benefits, which is up sharply from the 37% who did in 2008. But the financial cost of starting Social Security prematurely is steep because it locks in a smaller benefit for the rest of the retiree's life. All right, so we talked about, let's see, unfortunately, the people who claimed Social Security early in the wake of the 2001 recession had fewer financial resources to begin with. Namely, their earnings were lower, they had less wealth, and they were less likely to have a spouse to fall back on. As the economy recovered, workers stopped grabbing their benefits early, and the longer term of a falling share of 62-year-olds claiming Social Security early resumed. This time around, the depth and duration of the expected recession will determine how many older workers will claim their Social Security early. Federal Reserve has predicted the unemployment rate could reach records like the Great Depression, and like the U.S. economy, older workers are entering uncharted waters. So basically what the idea is that as we have a significant risk to the economic viability of the United States, low interest rates, markets, volatility, people are going to just go to the sure thing, and that's a huge mistake. Let's go what the Morningstar says now, because they have written an article on this just not too long ago. Is delaying Social Security still smart? And this is April 30th. We're going to read what, right here, Blanchett, right here. I want to talk to you, Blanchett. I saw it. Hold on. Let me pause it real quick. So here's Blanchett from Morningstar. David Blanchett, I'm a big fan of. Regarding the question about taking Social Security early because of market decline, it's true that stocks drop between late February and late March accentuates their return prospects a bit. That means because they're cheaper value, there's more of an upside. Thus, taking Social Security early would make sense if the market is down, because you allow your stocks to return to more profitability because the prices are cut. But David Blanchett argues that stocks are still likely to underperform the 8% annual benefits you get from delaying Social Security. I don't think it's going to be possible to beat delaying claiming Social Security with equities for the average person today. And that ignores the fact there is significant risk to equity investing, as we just went through. But Social Security benefits are guaranteed. Indeed, he argues that stocks are not the right point of comparison anyway, because the benefits and enhancement of delaying retirement delaying filing is guaranteed. The best point of comparison would be safe investments like cash and bonds, whose yields have been depressed by the Fed's actions and ongoing tight flight to quality. Now that interest rates are lower, it means the benefits associated with delaying Social Security are even greater. Social Security is technically a better deal now than when it was a year ago. Man, that's 100% right. And I mean, I'm telling you. So remember, the reason we got the 8% delayed earnings credits was because back in the, I think it was 83 on the Reagan bill. I think that's what it was. It doesn't matter. The rates are much, much higher back then. All right. You were getting a 15 and a quarter 30-year treasury. You know, the 10-year treasury was in the double digits. So basically an 8% delayed earnings credits was incredible now, but it wasn't incredible back then, because you're getting more than that on bonds. But that was one. Now, they didn't inflate the taxation of Social Security benefits, but they didn't adjust the delayed earnings credits either. So they're using still the 1983 models. So now you're dealing with a 1983 model from a tax perspective, which stinks, but you're also dealing with a 1983 model on delayed earnings credits benefit, which is insanely good. 1% interest rate versus 8% delayed earnings credit. Before is 10% interest rates versus an 8% delayed earnings credits. I hope that makes sense. That's a big flipping deal. Another reason why you delay. All right, so let's see. What about other levers? People sometimes try to invest their way out of a retirement shortfall, since stocks tend to outperform bonds. But what we've just experienced is an example why this is a bad idea, because market drops. Yeah, exactly. I couldn't agree. They talk a little bit about doing reverse mortgages, all that stuff. Finally, in addition to portfolio market considerations, some investors who have been planning to delay Social Security might be feeling more anxious about the health of the program. The annual trustees report released last week indicated that the Social Security Trust Fund will be exhausted by 2034, barring changes to the program. We already talked about that. At the same time, it's worth noting that the fund only covers about a fourth of the cost of the Social Security program. The bulk are paid through payroll taxes. Thus, it's a mistake that Social Security benefits will go to zero. Exactly. I could not agree that more, for sure. So what's happening here? I just think delaying makes it more sense. If you have bonds on the side, take those first. If you have cash on the side, take those first. Isn't that right, Pablo? Isn't that right? Bonds or cash or Social Security? Social Security delay, says Pablo. Get rid of your bonds and cash before you tap into Social Security. That's all there is to it. Now, if you don't have bonds and cash, well, you should, because that's the whole point about the bucket portfolio, the barbell approach. But if you don't, that's something else you're going to have to think about. If you lose your job, that's something else you're going to have to think about. But man, tap into your bonds and cash before you tap into Social Security. In my opinion, it's just not even debatable. All right, we'll see ya.